12, 2022 August. Yes. Read it. Let's see. No. It's not on the page, it's a past question. And that one you have the please ask for the past questions. Get them. Once they repeat the questions, either the same question or a modified form. Then we revise what we did last week for me to know whether what I did was absorbed. Whether I continue. Is it now on the platform?
I sent it to them.
No, post it on the platform. Somewhere online.
Okay.
What did we do last two meetings when we met? Before I can continue, what did we do? Because if you don't remember, this question I have posted, you will not understand it. What did we do?
We look at trust. And then we also look at international and personal capacity.
No, they look at residency of an individual, residency of partnership, residency of a trust, residency of a limited liability company. Then we came to look at, I remember, international taxation. What constitutes international taxation? And then where Ghana enters into any arrangement with another country. In the case of any inconsistency to the laws of the country, then the international law or the international arrangement will take precedence over the domestic laws. Then I remember I also looked at double taxation. And then I ended with no, I did not end the permanent establishment. Or did I?
No, we didn't.
So that is where.
We looked at the methods of writing documentation.
Okay, yes. Yes, that's where a resident, if an individual or a company which is having residence for tax purpose in Ghana for the year of assessment will be taxed on the person's global income. So whenever there is a foreign source income, then what Ghana will do is that the person will be granted a foreign tax credit on the taxes paid outside to the extent of the tax payable in Ghana. So what it means is that if you pay more tax than what you are supposed to pay in the country, then not all of the country. That is why I said look at that person as a revision.
So I have a question with the methods of granting the compensation. We have a credit, exemption, and deduction. When do you know which one to apply?
Okay, when you look at deduction, for an individual, you cannot be granted a deduction. And if you are an individual, so always when it is about a company, registered entity, then do well to look at deduction method. If it's a company, but if it's an individual will go for the credit method. So for the exemption method is applicable when there is employment where I remember saying that per section 112 also that if you have a resident individual who is engaged when you have a resident individual who is engaged by a non-resident person and that person exercises the employment outside the country, then the person's income from that employment is exempt. I remember I mentioned that. Then again, you have the employer to be a resident person in Ghana, but this employee carried out the condition of the employment outside Ghana for a period of at least 183 days continuous. Then that person's income from that employment will be exempt. We'll look at these two. For deduction method, it will be applicable to entities. I think you were tested in one of the years under the deduction, I think July 2023. Yes, it was a deduction method. So under the deduction method, what you do is that you subtract the tax paid from the foreign income and you add the difference to the person's income and taxes so that you not come back and grant foreign tax credits. You only take the income from the foreign source minus the tax paid in the foreign source income. Then the net amount will be included as part of the company's income and subject to tax at the Ghanaian rate. Read that question. Is it okay now? Read question 3. I only want to look at a part of it.
The requirement is to prepare a briefing paper to join on the tax implications of a company. We advise him on the.
Says you are to prepare a briefing paper. A briefing paper. So apart from knowing the concepts that are in the question, you need to know what a briefing paper is. A briefing paper could be, let's say, a report. This is not a memo. This is not a memo. So you only have to caption it a briefing paper on tax implications of so and so. Then you begin maybe with introduction and then you continue with the body. Then when you finish, it must be signed, and maybe you have your name there. But what will go into the body will be the concepts, the tax implication. So read it.
I said about the memo and report. It's not the same format.
No, reports are different. Reports are different from memo. The format of a memo is different from a report. A memo in our offices, when you are writing a memo, I attended a workshop. They did not say I should write a memo. They said I should write a report on the workshop I attended. So what I'm going to do is that if I sit down, I'll write what I went there from the day that I went there to the last day I returned. And that could be part of my introduction. When I come to the body, I have to talk about the activities that took place. If I spent 1 week, then I'll give activities that took place within the week, what I learned from there, and then I'll bring my conclusion. Then if there are suggestions to the company, then I will suggest them as part of it. That gives you a report. But for a memo, you write it from maybe you are the accountant and you are writing a memo to maybe your immediate supervisor or the head of the institution. That one, a memo is not formal method of communication. So you begin with maybe from, to, date, and then the subject will come. Then right away you begin your body. No introduction, no nothing. So you write from, to, date, and then the title or the subject. Then you just begin with it, no introduction. But for a report, you need to have introductory aspect of it. You come to the main content or the body. Then you sign out by who wrote it. That is a report. So read this one. So this briefing note, instead of saying a report on, you only say a briefing note on tax implications of so and so as your subject. He is a Ghanaian citizen. Please take note. Once he says he is a Ghanaian citizen, John Zuki is a Ghanaian citizen, then right away you need to ask yourself, what is this question about? It is about one, residency of an individual. Once the person is a Ghanaian citizen, then you look at residency. It says that one, a citizen other than a citizen with what? A permanent home outside. So you have to look at the question and relate it to residency. How will an individual be subject to tax when the person is a citizen who is resident for tax purposes, or a citizen who is not resident for tax purposes? Continue. So identify that John is a citizen of Ghana. And now continue.
Who has lived in the Republic of Liberia for many years.
Has lived in Liberia for many years.
He is also a citizen of Liberia.
So dual citizenship. John is a citizen of Liberia. I remember that if you are a citizen, you could be resident for any year of assessment. You could again not be resident for any year of assessment. So the fact that somebody is a citizen of Ghana doesn't mean the person is resident for tax in every year of assessment. Continue.
He is an employee of the multinational company that has a subsidiary company in Ghana and Nigeria.
He is an employee employed by a multinational company with subsidiaries in South Africa,
No, in Ghana and Nigeria.
in Ghana and Nigeria.
He works for the Ghanaian subsidiary company.
So he works in Ghana.
But his role makes him work for the other subsidiary in Nigeria as well.
And then he is also working in Nigeria.
God has chosen Ghana as a place of his permanent, even though
He has what?
he has chosen Ghana as a place of his permanent home.
So permanent home is in Ghana.
Even though his immediate family is based in the Republic of Liberia, and he visits Ghana anytime during the year.
Okay.
In 2018, John spent
So the year of assessment, 2018, what happened?
John spent more than 184 days outside Ghana working for the Liberia office. In addition to his employment income in Ghana, he earned some income from a high-yielding fixed deposit account maintained with Bank of Africa Ghana. His gross interest income for the year 2018 was 10,000 from Bank of Africa. A few years back, while studying in the United Kingdom, he maintained some high-yielding interest-bearing account, from which he earned 3,500 pounds in 2018. John does not know how the current income tax law income tax act 2015 at 896 will affect his income earned from Ghana and also in the United Kingdom, and is worried that he will be liable to tax on all his income in Ghana. He is keen on getting tax planning advice from you to enable him to reduce his tax liability if any. John also had serious business interest in Ghana. In view of this interest, he set up two companies limited by shares in Ghana, in which he implemented his business ideas. The following are the objects of his two companies. One, farming and production of palm fruit and commercial scale and processing of palm fruits into oil for both local and international markets. John, together with his management team, strategically decided that each of the companies maintains equity in each other in order to avoid difficulties with sourcing for external funding, thus raising income from dividends within his companies effectively. John intends that at some point he will merge the two companies into one to avoid all the legal compliance obligations and limitation of costs associated with running separate companies. All the two companies are installment taxpayers and are required to file their self-assessment estimates at their various times. Don't just reduce your assistance to enable him to structure his personal and business future so as to minimize the tax liability. Prepare a briefing note to John on the tax implications on him and his company. Advise him on the compliance obligation of his company and self.
Okay. So I'm only interested in your ability to identify a person's residence for tax purposes. So in this case, somebody will say John is a citizen of Ghana. He is also a citizen of Liberia. Then John is employed by a multinational, which has subsidiaries in Ghana and then Liberia. John works both in Ghana and Liberia. But he says he has a permanent home in Ghana, though his family and other social ties are in Liberia. But in the year 2018, John was outside Ghana for 184 days. Per the provisions of the Act, it says that if you are a citizen who doesn't have a permanent home outside, then it means that for any year of assessment, you are liable to tax for the whole 365 days. For the whole year, if we see you as resident individual, then for the whole year, you are seen as resident. And therefore, even when you travel outside to spend some days, you are still recognized as resident for tax. And when you are recognized for tax in Ghana for any year of assessment, then you will be taxed on your global income, irrespective of where the source is from. We put all together and then tax you. And when you are taxed, you will be granted a foreign tax credit for the taxes that you paid outside to that foreign entity. So that is what this question was about, the first part. As for the company, I'm not looking at the company now. So when we were ready, I did not listen to the company aspect. Because he is an individual, you have to identify his residence. If you go to the company, what you do is that you identify whether the companies are registered in Ghana. If they are incorporated in Ghana, then they will be liable to pay taxes in Ghana. Once they are incorporated in Ghana, they will have to withhold taxes, file returns. That is why it was talking about self-assessment regime. So you file your returns quarterly and then annually, and pay your taxes as well. So please, when the questions are there, Having gone through all the years to date, I saw that August 2022 was when they actually wrote an exams, because the questions were not 3 marks. So that is the principle, the residency principle that we did. I wanted to test you on that. So that is a summary of it. You can go and try it. Very simple. So don't say the person stayed outside Ghana for 184 days. Therefore, the person is not going to be subject to tax in Ghana. We are subjecting him to tax because he has a permanent home in Ghana. If the permanent home was outside, then 2018, he comes to spend 184 days in Ghana. He will be recognized as what? Resident. Because if you are a foreign national or you are a citizen with a permanent home outside, the second law, the part says that the B part says, if you spend 183 days, so if he came to spend 184 days in Ghana, from the day that he spent 183 days, he will be seen as resident. So please, the same question, we can change it. From here, for the 2022, he was seen as resident for tax purposes in Ghana because he has a permanent home in Ghana. Once he has a permanent home in Ghana and is a citizen, then he will be taxed for the whole year. He will be seen as resident. And during that year, even when he gains income from outside, it will still be part of his assessable income for the year and will be subject to tax. Then the taxes paid outside will be granted to him as foreign tax credit to reduce his tax burden. Any question? So that was on residency. If you take 2020, I think May, we tested on double calculation. So please, as for the past questions, practice them. But this question that was presented, I can only make a few changes to it, and it will change the answer. Like the one I said, that he doesn't have a permanent home. I'll delete the permanent home and tell you he spent 184 days in Ghana. The person will be resident for tax from the date that he attained 183 days. Then the same question, I can change it. That from the date, the person doesn't have a permanent home in Ghana, but is a citizen of Ghana. Under that situation, it means he spends most of his time outside. But here's the case: he visited Ghana, came to stay here, spent 184 days in Ghana. So from the day that he reached 183 days, from there onwards, the person will be seen as resident.
So, say, if the person has to the whole translates, if he's seen as resident.
If he's seen as resident, once you are seen as resident, then we are going to tax you for the whole year.
But if it happened that he was a resident, the didn't have permanent home here.
He was.
A citizen.
Because I saw that you wanted to say citizen.
And but spend, just like this question, spend 184 days outside.
184 days.
And have a permanent home outside.
He has a permanent home outside. And spends 184 days where?
Outside.
Oh, if he has a permanent home outside, then he becomes non-resident. Non-resident. So once you are non-resident, then the law is saying that you will be seen resident when you spend at least 183 days. But what you should have asked is that when will he be taxed if he is seen as having a permanent home outside? If he has a permanent home outside, then he is going to be taxed only on income that has a source in Ghana, because you are non-resident. Permanent establishment. We said that for companies, you are taxed when you have your incorporation in Ghana. In Ghana, you are registered under the laws of Ghana. But not all companies are registered in Ghana. Please understand this principle of permanent establishment. It's very simple. Not all companies will be incorporated in Ghana as a limited liability company. So what happens is that I'm not registered or established in Ghana. Then I still engage in some activities in Ghana here. I come to trade here in Ghana. I get contracts in Ghana, even though I'm not a company registered under the laws of Ghana. For a non-resident company or entity, you are going to be taxed if you have a permanent establishment in Ghana. If you have a permanent establishment in Ghana, we are going to tax you in the same way as a registered company in Ghana. So you have the obligation to file returns, withhold taxes, and pay taxes by the due date. The same principle. So your ability to understand what a permanent establishment is will help you to know the tax implication when there is a company. For instance, this question that we were looking at, John was an individual. So for an individual, you will look at having a source of income in Ghana if you are not resident. If you are a company, you have a source of income in Ghana if you have a permanent establishment from which you are getting what income. That is when they say you are going to be taxed in Ghana. Remember, we said a non-resident company is not registered under the laws of Ghana. If you are not registered under the laws of Ghana, what it means is that you become non-resident. If you are non-resident, we will tax you on only the income you are getting with a source in Ghana. But you are non-resident and you have a permanent establishment in Ghana here. You have a Ghanaian permanent establishment. You will be taxed in Ghana. Are we okay? We are not taxing that company which is incorporated outside. We are taxing the establishment in Ghana. And when you have paid all your taxes and then the permanent establishment wants to remit your returns to you, then we will again tax you what is called the branch profit tax. So that is the very principle. Just like if you are a shareholder of an entity and the entity declares dividend, you pay tax on the dividend. In the same way, if you have a permanent establishment and it is also remitting your returns to that entity which is non-resident, it must also pay tax on that. And that portion of the tax is called the branch profit tax. So this morning we want to look at what
the particular income tax paid on each one. Where the permanent establishment pay 25%. And when they are sending it to their parent company, let's say parent company, that money is also tax is also
yes. Yes. And that's one is why we are calling as the branch profit tax on the repatriated profit to the parent company. Tax on non-resident. What's your say? Okay. If we look at these two concepts, the concept of trade, I mentioned it. What do we say about it? Because it's linked to this. So you have a tax residence. In Ghana. So it means you are engaged in economic activities in Ghana. If you are non-resident, so if you are non-resident and you are creating a tax residence in Ghana, then you will be subject to taxes. But trading with Ghana does not create any tax residence. So because of that, you will only be taxed on the income that is sold in Ghana. So that is the whole principle. If you are non-resident, then a non-resident will be taxed if they are trading in Ghana. And one way to trade in Ghana is permanent establishment. So if you have a permanent establishment in Ghana, it means you are trading in Ghana and therefore you will be subject to tax. We'll get to know the difference. But they will usually ask you differentiate between the following. trading in Ghana and trading with Ghana. So what is a permanent establishment? When you say a permanent establishment, what it means, meaning examples of permanent establishments. We look at under the Income Tax Act, the types of permanent establishments. Let's finish. So what is permanent establishment? We say that a permanent establishment is a fixed place permanent establishment is a fixed place through which the business of an enterprise is wholly or partly carried out so a fixed place where enterprise is using to carry out their business, wholly or partly. What it means is that if, let's say, a company owns this premises and the entire premises is used to conduct business by that company or enterprise, it means it is what? Wholly. But let's say this fixed place is not owned by the company, but a portion of it. They share it with others. Or if it's a building and you have only one room which you are using to conduct your activities, it will be seen as what? A fixed place that is what? Partly used. The fixed place could be in terms of a building. It could be in terms of a geographical area which is at the disposal of the enterprise. And because of that, the enterprise is using it for commercial activity. In that situation, it becomes a permanent establishment. Are you okay with the meaning? That a place which is at the disposal of an enterprise, and that enterprise is using that place for its business. So if the enterprise is into any form of business, then that enterprise has that fixed place. And once you are using it to generate income, then all income must be subject to what? Tax. That is why the concept of what? Permanent establishment. Remember that we said a company which is incorporated in Ghana is resident for tax purposes. Otherwise, those entities will be saying they are not incorporated in Ghana, and therefore any income we are making from Ghana here will not be subject to what? Taxes. But the principle of permanent establishment will help us to tax those entities even though they are not registered. Examples of permanent establishment. Permanent establishment includes an office, a factory, a place of management, a building site or construction site, a mine, oil well, quarry, among others. So if you have any of these places from which you are carrying on business, then it becomes a permanent establishment. And the permanent establishment doesn't mean it should be something that goes on continuously over time. It's not that you come and do one activity there today and then you are gone. And we say you have a permanent establishment. You need to create a permanent presence. So let's look at section 107 and see the types of P. So per the Income Tax Act, P could be put into two P. We have the Ghanaian permanent establishment, and then foreign permanent establishment. Please, I don't want us to read through, but I'll give a summary and then you read and see. Ghanaian permanent establishment. Remember, we say a P is a fixed place where you are the business of the enterprise is carried out. So we said we have resident and then non-resident. So if we categorize P into two, then P that will be called a Ghanaian P is one where a non-resident, a fixed place in Ghana, where a non-resident is using for what? Business. I get it. So the Ghanaian P, a non-resident, a fixed place in Ghana, from which a non-resident enterprise carries on business. Then that will be foreign P. Not resident Ghanaian. Local Ghanaian.
Resident.
And I mean income in Ghana.
A resident enterprise carries on a business.
So
Use the P to carry on.
yes, it can. P. What's that? Can Ghanaian foreign P? What's that? Use the P. So listen again. Ghanaian P is a fixed place in Ghana through which or from which a non-resident carries on business. So if you have a place in Ghana where somebody who is seen as non-resident entity has and is using to carry on business, then that becomes Ghanaian permanent establishment. The opposite is that a foreign P can
A fixed place outside. Where
outside where a resident who the Ghanaian
a resident carries on a business.
But here there is continuity should be continuously for 183 days. It's 183 days, almost 6 months.
Yeah.
So here there is, this one is a Ghanaian company operating outside, and that fixed place is outside. So if you establish an entity outside, you say you have a P, foreign P. The time limit you have to operate there continuously for 183 days. It is available to you, and you have conducted business activity from that fixed place for at least 183 days. You become a foreign P. Then the Ghanaian P is that fixed place in Ghana from which a resident entity carries on business. Now you can go to section 107. So what else you see in here? Yeah, garbage. Ghanaian P. So we will put a P to be separate from the owners, just like a company. The company is separate from their owners, their shareholders. The same way a P2 will be separated from its owners.
Is subject to tax under section 1 in the same manner as a resident company.
So, taxing principle. So, a P is separate from its owners. Then, subject to tax in same manner as or let me say as resident company. So, subject to tax in the same manner as resident company if it is GP Ghanaian Permanent Establishment.
And in accordance with section 1112, it's exempt from tax if that permanent establishment is situated outside of the country.
So, if the PE is situated outside Ghana, it becomes what form of what? It becomes what form of PE? So, foreign PE is exempt from tax under section 112. So please take note here. Foreign PE, after attaining the 183 days, thereafter, we will exempt your income from taxes. That is why the point C, that if it is situated outside the country, then it will be exempt from tax under section 112. So before the 183 days, then you will be seeing all your income will be included. Because remember, this one is a Ghanaian a resident person in Ghana who is owing that entity. So it becomes global income. But after the 6 months, then it will be what? Exempt. Continue.
After the 6 months,
we are saying that a foreign PE is a fixed place from which a resident person has and uses for business continuously for at least 183 days. So, if 183 days, after you have included the income for 183 days, after that, those 6 months, it becomes exempt under 112.
In accordance with the first section 1, A, the income of a permanent establishment and any tax liability is computed as if that permanent establishment and its owner were separate but are persons in a controlled relationship.
So if we are computing their income and they are seen as persons in controlled relations, then it means that all transactions, remember the first one said they are separate from their owners. So all transactions should be at arm's length. It should be at arm's length. So transactions between PE and owners must be at arm's length standard.
That permanent establishment is separate but are persons in a controlled relationship, and that permanent establishment is a person resident in the country in which it is situated. B. Part 8 applies directly. The Ghanaian permanent establishment separate from its owner. And arrangement between the permanent establishment and its owner are recommended. A Ghanaian permanent establishment shall be compliant with Part 8 withhold tax from a payment
So
made by that permanent establishment.
if you are a P, if you are a Ghanaian P, then what you do is that you have the obligation to withhold tax. So whether the transaction is between you and then a third party or your parent, you must withhold what? Tax. Obligation to withhold tax and file and pay, say, by the due date. So any payment you make to any person, you must withhold tax, provided that that transaction is subject to withholding taxes. Can we continue?
Withholding tax on payment received by that government establishment in the same way as a resident company. Pay tax by installment as transferred.
So,
in the same circumstances as a resident company.
so must pay taxes by installments. So you pay taxes quarterly, installments, and then you file returns annually. File returns annually. So if you have a Ghanaian P, these are some of the things you have to do. Your obligation under the Income Tax Act of 2015 as amended. You will be seen separate from your owners. If you are Ghanaian P, you have to be subject to tax in Ghana. Though you are a P, yet you have to be subject to tax. How are we going to subject you to tax? We are saying that you will pay taxes by installment. You will file your returns annually and pay the taxes thereon. Then you have the obligation to withhold taxes for any transaction with any person. So you don't say this one is my parent and I had a transaction with my parent, so I will not withhold tax. You will have to do it because we see you separate from your owners. Are we okay? Continue. Has it finished?
The arrangement specified in section 1093 as between a Ghanaian permanent establishment and its non-resident owner are recognized and attested. 5. Subject to part 3. While this subsection applies, the following entities are recognized each shown in the same manner in the accounts of the product.
So here, all you have I want us to look at, now we have defined this one. What activities will be considered as Ghanaian P, for which when a non-resident person engages in or has as at his disposal, we will say you have a Ghanaian P. As for the meaning here, you have known it. Let's go to this section. One. Go to section 1. Which one were you reading? 107. Yes. 10. Section 110.
In this part, unless the context otherwise defined.
In this paragraph, unless the context, how it has been used, requires.
A foreign government establishment means a fixed place of business.
So that's the meaning. Read it.
A fixed place of business of a resident person situated in a foreign country where the business is conducted continuously for at least 6 months, but excludes any place as if only activities of a preparatory or auxiliary nature are permitted.
So please take note here. Foreign P, that fixed place is outside. A resident person has it and uses it for business continuously for 6 months. So it says unless you are using the place for auxiliary and then preparatory activities. What it means is that you are not, if it's about products that you distribute in that country, you don't process it. You don't sell them. You only keep them there and then you later on distribute. Auxiliary or preparatory activities. Unless that it is so, you are not generating income. So you keep it there. Let's say, what typical like you process cassava into root beer. So for preparation, when let's say you have a fixed place where you bring the cassava and you keep the cassava there, you have not worked on them into root beer. So we will see it, that fixed place as preparatory place. So that means you are not going to be seen as having a P. Are you getting it? But immediately you process the cassava into the beer in Ghana, that doesn't become preparatory. You have processed them into, so the place that you will have from which you will be selling the beer becomes a P. And therefore you must be subject to tax if it is in Ghana. If it is outside Ghana, then we will say that for the first 6 months, the income that you are getting there, include them as part of your income. But after the first 6 months, then the income will be exempt from here. So when they ask you to write on the taxing principle for foreign PE, then what you need to tell us the meaning of foreign PE. You tell us how it is taxed. For the first 6 months, it is going to be taxed in Ghana. After the 6 months, the income will be exempt from tax. Are we okay?
So a Ghanaian with a foreign PE is subjected to 6 months tax.
Yes,
Then
on the
after-
incomes within the 6 months. After the 6 months, it is exempt from tax. Continue with the reading.
Ghanaian permanent establishment include
So Ghanaian permanent establishment includes, so includes a place in Ghana where a non-resident,
or that is at the disposal of the person for that purpose.
so a place, so examples of Ghanaian P, a place in Ghana or at the disposal of a non-resident person for business. So a place, if we say is at the disposal of a non-resident person, what it means is that a non-resident person is using that place. It doesn't necessarily mean that the person owns that place in his or her name, but the person has it and is using it for business. Continue.
A place in the country where a person has is using or is installing substantial equipment.
A place for installing substantial equipment. A place for installation of equipment. Equipment or machinery.
See, a place is the country where a person is engaged in a construction, assembly or
A place for construction. So, assembling and what?
assembly or installation for 90 days or more.
And installation of products for 90 days or more.
Maybe the place where a person is conducting supervisory activities
Or conducting supervisory activity. So the A, please, let's take note here. The A, you have a fixed place in Ghana you are using for business as a non-resident. That place you are using for business becomes a permanent establishment in the form of Ghanaian PE. Then 2, you have a place where you are installing an equipment. Whether as for me, it is an equipment. For instance, Kennedy Ejapon says he's building a company. He has that he brings some Indian people to do the project to install those equipment. So, if that company is engaged in that activity in Ghana, for the fact that they are coming to install their equipment here, we will say they have a PE. So if they have a PE, what does it mean? They must withhold taxes and be subject to tax in Ghana for that period that they are here to install that machinery. When you take the mining companies, they build what? Machinery, equipment. So if you go and bring a foreign company to come and do that in Ghana here for you, you must subject them to what? Taxes. Are you getting it? Then the C part is saying that a place in Ghana here where you are using for construction, you are here to construct maybe a road, you are here to install a project, you are here to assemble some parts of equipment in Ghana here. And that exercise is going to take at least 90 days. You must be seen as having a PE. But if you spend less than 90 days to do the construction and you are non-resident, then for you, you are still going to be non-resident without what? A PE. But if the construction site, you are going to work there for at least 90 days. Immediately you attain that 90 days, you will be seen as having a PE. So the best thing is that the tax planning benefits that will be seen here is that that non-resident entity should not undertake the construction for more than 90 days. So when you win a contract, I remember one of the years, they said a company won a contract to construct roads in Ghana. So if you read, and that company, which is non-resident, is going to undertake this road construction, then it will be seen as having a Ghanaian PE, which is in the form of what? Construction. And if it's construction, if you don't want to be tagged as a PE, then it should be less than 90 days. If it's more than 90 days, then you will be seen as having a Ghanaian PE. If you are a Ghanaian PE, then the principles will count. You will be taxed in the same way as a registered or resident company. 2, you have the obligation to withhold taxes on all transactions with all persons. 3, you must pay taxes by installment. So you pay taxes by installment, so file your returns under the self-assessment. File returns, pay taxes by the due date. Otherwise, if there are penalties, you pay them. Then finally, if you repatriate any profit to your parent company, that repatriated profit must suffer tax at 8% as branch profit. I have continued. So construction site, or maybe the person came here to do supervisory activity. If it's going on for 90 days, you must pay the same as a permanent establishment. D.
The provision of the services in the country.
So a fixed place, a place for provision of services in Ghana. And this was what you were tested last sitting. They said, right for then, and which a foreigner is seen as having a Ghanaian PUs again. These were the things.
So this way, you have to make an introduction.
So that was the same question. Also, you remember an answer yet?
There are many ways for
non-resident entities. So there are many ways non-resident entities may what? May launch their presence into a country. So launching your presence, so tax presence. I remember I mentioned that. Trading in Ghana. So instead of saying may trade in Ghana, it says may launch their presence.
Some of the ways include the establishment of subsidiary, licensing.
So how they can do it is that they can have a subsidiary in Ghana. If you have a subsidiary in Ghana, we call it a subsidiary P. So you are non-resident, you are a foreign company, but you have a subsidiary P.
License.
So you can have a license. And what? Permanent establishment.
Right, for different scenarios, permanent establishment may be created in Ghana, and how they may be subject to tax.
These are the four scenarios.
So you just because I'm asking this because of the professional I try to the different courses that I do. Some would say that you not tax, but another side will say in whatever question they ask you, you have to be to give an introduction. So I'm asking in this case, you need to explain what the so you just go ahead and mention them.
That's why I want you to get the preamble right. If you get the preamble right, there is no need explaining permanent establishment. Because already the question mentioned that they could have a subsidiary, they could go through licensing, they could have a P. And it says, give four scenarios. So the first scenario is that they could have a place in Ghana where they could be conducting their business. A place in Ghana where they will have what? Installation of equipment. A place for construction for at least 90 days. A place for provision of what? Service. So you don't need to write so many because he said for how many months? 8 months. So 2 for each.
It says
and the tax implication, wow, yeah, or ticket, we know 111.
Okay.
More ticket, tax implication, so 111. When you're 8. So what you will do is that you only have to put the first part, the redetermined.
And say 4 different scenarios.
So
A permanent establishment may be created.
you see, there is a permanent establishment may be created in Ghana. If you create a permanent establishment in Ghana, we say it is called a Ghanaian P. So this question is asking you, mention 4 examples of Ghanaian P. And these are the 4. Are you okay? Then you come to, it says, and the tax what? Implications.
How they be established tax.
So the first one is Ghanaian 4 permanent Ghanaian P's. Then you underline. Then you only list them. You list them. Nothing other than 1 sentence. Bullet. 1 is it, 2 is it, 3 is it, 4 is it. No worry. Then you come to the how they may be taxed. That is tax implication. You put it there. 1. The P will be seen separate from its owners. Then 2. It is subject to tax in the same manner as a resident company. 3. Transactions between them should be at arm's length. 4. They have the ability and obligation to withhold taxes and pay it by due date. Now you say, what's your idea now? Why? So what is it? So that is how you should do. Then once this is examined, then look at taxing of foreign P, what we describe, because we don't know. Once it's tested this way, next sitting they can choose to make it very simple for you to write on Ghanaian P and then foreign P, how we tax them. The Ghanaian P is taxed in the same manner as a resident company. A foreign P for the first 6 months is subject to tax in Ghana. Thereafter, the income of a foreign P is exempt from tax. What will be this one? The year beginning 50 plus 1. It says I'm sending for an application. Any question on P? So
with the foreign P, it's just this one line. Exempt from tax and that cannot quantify.
you state the meaning of foreign P. Then you tell us that for the first 6 months, the income is taxed out. And thereafter the 6 months, the income of a foreign P is exempt.
Provision of services, basically, the company and agent performs any function on behalf of a non-resident person.
So, a place.
A place in Ghana, so it is in Ghana, so it's a place in the country where an agent performs any function on behalf of the business of a non-resident person.
Of a non-resident.
Yes,
So what it means is that here we are having a dependent agent. A dependent agent. So please take note. We have independent agent. And we have dependent agent. So for independent agent, if you are operating and you have an independent agent, then you don't create a tax presence as a fee, but from the Ghanaian fee principle. But if you have a dependent agent who is acting and performing the functions of that non-resident agency, then that entity is seen as having what? A permanent establishment in the form of Ghanaian P. Are you getting the principle? If the person is independent agent, then it will not create a P. But if the agent is dependent on the parent, then it will be seen as what? A P. So you will be seen paying taxes in the same way as resident company. We'll take note of that when it comes to trading in Ghana and trading with Ghana. The same thing will happen. Okay. The last part, repatriated profits of P in Ghana. Then we will end with P. Now I want to believe you know the meaning of P. We can mention examples of P and then the types of P. Ghanaian P, foreign P, how each one is going to be taxed. Are you okay?
the examples and the types are they different?
Yes. The examples is about if we say you have a Ghanaian P, a place in Ghana you are using for your business. Is it an office that you have in Ghana? Is it a factory that you have in Ghana? Is it a place of management that you are having in Ghana? That is Ghanaian P. Then if it's foreign P, is it an office you have outside? Is it a factory you have outside? These are examples. Is it a mine that you have? If it's a mine that you have, is it in Ghana? If a non-resident has a mine in Ghana, then you see it as having a Ghanaian what? P. Because of the mine that you have to generate income from business. If they say give under the provisions of the Income Tax Act, then let this, you don't go and mention examples. Okay, repatriated profit. Say that if you have a bill, you are to be subject to tax separate from your owners. So when you want to remit any amount after your taxes to your parent company, which is non-resident, then the act says that you must pay 8% of the repatriated profit as tax to the Commissioner General. We withhold it on the repatriated profit. So let's say during the year of assessment, at the beginning of the year, you had some reserves brought forward of 2,000. Then at the end of the year, you had a balance of, let's say, 4,000. Then there is a movement, which to me, I will see it as some profit of 2,000. Let me make it quite. So, on this profit, if you decide to remit all these 2,500 to your parent country, then we are saying that pay branch profit tax of 8%. If the entity did not remit all the 25, and it was, let's say, 80% remitted, then you work 80% of that amount and tax 8% on it as the tax. The other becomes retained. Are you okay? So please take note of that. Then this one, it is always tested in theory. The computation has not come. The computation which came was in principles. They tested them in principles. Calculation. So we are saying that repatriated profits on, let's write something. Read section 60 and then confirm something. Section 60. Section 60.
Branch profit tax. A non-resident person who carries on business in Ghana through a permanent establishment and who earns repatriated profit shall pay tax on the repatriated profit earned for a basic period ending within the year of assessment. A non-resident person who has earned repatriated profit under subsection 1 shall pay a final tax on the gross amount of the earned repatriated profit to the Commissioner General in accordance with the prescribed rate within 30 days after the end of the business period.
Okay.
3. For purposes of subsections 1 and 2, a person shall treat the portion of the net profit of the resident person which corresponds to the interest of the non-resident shareholders as repatriated profit and as dividend distributed in accordance with the respective shares of the non-resident person in the company.
So I remember saying that if resident entities are taxed, the shareholders will also be taxed on their dividend. I remember I said that. So if you are a non-resident and you have a PE here in Ghana, you are also going to suffer tax on the repatriated profits because we are going to see tax what dividend. So it may suffer tax at the rate of 8%. So that is the meaning. And he says you should do that within how many days? 30 days after the basis period has what? Ended. So if they ask you to write tax implication of having, so we can even add this one to the taxing principles. Add it to it. Within 30 days.
For example, it's left right.
Says that a P which repatriates profits.
Right.
Doesn't mean I'm writing it. A P which repatriates profits to a non-resident person shall withhold a branch profit tax at 8% on the gross amount of the repatriated profit. And pay to the Commissioner General within 30 days after the basis period of the person. So when I say person, I mean the company and not the non-resident company, the P. There is this question in the record each year. I try to solve it because I don't know when they will bring computation. It's 33, number 33 of the question bank, question 33. 33. The company is Gingi Company Limited. Reader read it. But any figure then multiply it by 2. Any figure you read the year of assessment, read it in 2023.
Five, determine the branch profit tax payable by Gingi Company Limited as a recontribution of profits according to the income tax act 2015 and 2026.
Okay, so that is the requirement. What are you to do? Branch profit tax. I think last week we did section 59 million and the taxation of shareholders.
Gingi Company Limited in Ghana is a branch of Gingi International Limited.
So Gingi Ghana is a branch of Gingi International Limited.
Registered, company registered in the United Kingdom.
So which one is registered in the UK?
Gingi International.
Gingi International. So what it means is that if Gingi International is registered in UK, it is non-resident for tax in Ghana. So under what condition will Gingi International be subject to taxes in Ghana? It must have a permanent establishment, a Ghanaian permanent establishment.
company limited in the United Kingdom engaged in the non-rental sector. The annual returns are measured with the Ghana Revenue Authority by the branch company for 2023. Year of assessment disclosed the following information. Net profit for the year before tax.
So net profit, so year of assessment 2023, net profit before tax. So tax has not been taken yet.
3 million.
3 million.
Net assets at the beginning of the year.
Then net assets at beginning of year
3 million.
10 million.
Net assets at the end of the year 12 million.
Net assets at end of year 12 million. So determine the branch profit tax. So by way of computation, please know your accounting principle. Profit for the year. So Ghana Limited. Please, this one is the P, not the international company. Computation of this compute the branch profit tax for 2023 year of assessment. So basis period will be 1st January 2023 to 31st December 2023. So net profit at the beginning of the year, net assets at start was 10 million. Then we add our net profit before tax. So this is before tax. We add the profit after the tax to our opening net assets. So add net profit after tax. Now here it was before tax, 3 million. So before tax was 3 million. And what is the rate of tax? The 25% of 3 million is 750. So take it from net profit after tax of 2,250,000. So in total, we will have 12 million. Then you compare this to the net assets at the end. So this should have been our net assets at year end. But here is a case we are saying the net assets at year end is this amount. So we want to know how much profit has been repatriated. So by comparison, net assets at year end was how much? 12 million. So how much profit has been repatriated? So we less it from that branch profits or repatriated profits will be 250,000. So you now take this 250,000 and work 8% of that as the tax that will be paid on the repatriated profit. Is it okay? We will do that.
When the net assets and the profit, are you always to calculate the tax when it's not after tax?
This one, the person said net profit before tax. So you will add the net profit after the tax
To the net assets.
to the net assets at the beginning. It's like in your office when you are doing what we call the accumulated surplus. You see that you have the opening balance, then you add profits for the current year, and then you come to get the closing balance. So in the same way, when we are getting our profit here, we are adding the profit after when we have deducted the tax to the opening balance, and then that will give us the closing balance. So when you compare, this should have been the closing balance. But when compared to what the question gave, you see that there is a difference of 250, and that 250 is assumed as repatriated profit to Guinea International. So we will have to tax the 250 at 8 as the branch profit tax. So the company is to determine pay 8% on this for the branch profit tax. Now this can be 20 months. If they give you this one is the balance sheet approach. If they give you the income statement, then what you do is that if there are any adjustments, add back, adjust them until you get the correct profit, tax that profit, then the net, if they repatriate all, you work 8% on that. So this one is the net asset approach. They will give you the income statement. So where you will have their income, their deductions. And some of the deductions may not be allowed. So you add them back. When you finish, tax them at their 25%. Then after you have deducted the 25%, if they remit all the 75%, then tax it at 8%. You get the principle. Was meant to be some examples and get the principle right. Okay. Any question on P? P. Trading in Ghana, trading with Ghana. A non-resident entity will be trading in Ghana when that entity creates a tax presence to a P. If it's a P in Ghana, then you will have a fixed place in Ghana here, which is available to you for business. A fixed place in Ghana, which you are using to install an equipment. A fixed place in Ghana, which you are using to provide a service. A fixed place in Ghana where a dependent agent has for business purpose. A fixed place in Ghana where you are undertaking construction for at least 90 days. If you are non-resident and you have any Ghanaian P, you will be taxed in the same manner as a registered company which is resident for tax. You have the obligation to withhold taxes. Transactions with your parent entity should be at arm's length, and you have obligation to file your returns by the due date, pay taxes on installment, and file your annual returns and pay any tax thereon. Then any repatriated profit to a non-resident entity must suffer tax at 8% as branch profit tax. Very simple. What we also better 51. Next 2 months 51. And rather we pay attention to the says yes, and we March Trump. You will be swimming. My chest guy registers member. Oh, Mamma. Yes, mention. Because I'm the anti-said, see that my quarter of my meeting and dash, I say, cultural tax. By international taxation, we are very the network yes, I see you somewhere September. Then the years ago, 2005. May not benefit online. May join a article. May join and at time I am 7:30 p.m. Until you are not good to make us. na network ni mentumi mpie nkɔ baabi adu nkɔyɛ na register so menyɛ sure sɛ mekɔ ɛbɛtwerɛ first week in February because leave koraa na ɛnyɛ leave ɔtena ha memi nkɔgu ase ɛna ɛnyɛ deɛ mekyerɛkyerɛ bi a deɛ kɔ nansa kɛyɛ no deɛ ankasa meti adeɛ aka no international OECD models nti anopɛ makyerɛ baako baabi a medefine PE ɛne examples ɛno nko ara kora 8 ɛnyɛ easy ɛyɛ August na mahwɛ kwan a mɛfa so atwerɛ na wokɔ so wosua adeɛ a meyɛ wotia mu Please, is it okay?
Yeah.
P me okay. International taxation. Residency. About Yami. So that is a say on two. Individual. The clinium, the robbery, the man for China said they are on the 11th, we meet. Next Friday, so who need the army? Who need the army? They are hobby, but with me, I have 3 papers. With me, that's not a child by this young or child by that's what now I'm what it you could have, but international taxation, I'm mentioning on the fall. And then they may go apply the mergers and acquisitions. Last sitting, I expected this one. It did not come. I expected this and then capitalization.
The stronghold co-position.
None came. So this might be of the own growth. Or so or Basua or Beto Hatro or Beto Hatro. I had 24. Veteran capitalization separate, mergers also separate. Expect 12 max for 24. Because last sitting, the third trend, not himself, the most of my trust. Trust. By this, it's
I don't want with me at 20 months. I said, trust
trust, then company is it in the oriented.
What they are working.
Company.
Your full trust in myself as a company with me out to fall.
Or the company, the company who are prepared, hard back, allowable, and non-allowable. Access to a trust in people, allowable.
Oh, they take me away. Miss Albert is the same to be a
Nti usua insua competition one. Nti na message concept na say. People go through competition na your concept na for their compete. Mergers and acquisitions. Some books will call it restructuring. Mergers and acquisitions. It is very simple. Open to section 47 of the Act. Meaning may define what is merger, what is acquisition. But merger is where entities pool their resources together to form a new entity, or only that the names could change. Maybe A and B are two separate entities. A will merge with B to become maybe C company, where they will change their names, or they will become A and B company. Acquisition is where one entity buys or purchases the shares of another entity, so that that entity will either gain control or have a right in the other entity. So when there is acquisition, it could be that the company, if all the shares are bought, then that company will cease to exist. Or I will buy a percentage of their shares. I have investment in that. It will continue to exist as that same one company. No change of name. But with mergers, it could be that we can change the name so that a new business will come. Like these people, they started with, is it Ariba? When it was coming, it was Space Food. Space Food. Then it came to Ariba, yes. And now it is everywhere we go.
Sir, is it true, sir, due to tax purposes, it's not on the side?
Yeah, I don't know.
We have to what
Because
It's not
they have
that.
some.
It's not that. But I remember that we said in business you call something synergy. Synergy, reasons for business restructure. That 1 + 1 is equal to 1. If we pool resources together, we are able to expand, become bigger in terms of resources, and you have to take advantage of the benefits. So maybe they want to take advantage of the benefits. Because under the law, if you change Space Food to Ariba, if you were enjoying temporary concession, you will still continue with the temporary concession arrangement. Let's say you are into agriculture, you have a temporary concession for 10 years. Is it tree crop? 10 years. Then you started as Space Food, enjoying 10 years. When you go to 5 years, you renamed to Ariba. Your temporary concession will not start again. You are still going to continue with the remaining years. So these provisions are there in the law. So even when you change, you are still going to take advantage of those benefits. But what people say is that they do it to avoid payment of taxes. You can't do that because when you do it, it comes to mergers and acquisitions. Is there continuity of 50% or more? If there is continuity of 50% or more, then you continue with it as the same company. So if you were having losses, you still carry them along. But you change it by MTN, then continuity has changed. So why do you still go and then deduct those losses you have? So when they are broadcast and what they can't hear, it's not true because the provisions of the law are there. To change here, what change will be, but who change it? What is called ownership. So you change more than 50%, you will be taxed. So section 47.
The realization of assets by way of measure, amalgamation or reorganization. The gains or realization of an asset accumulated to or derived by a company arising out of a merger and amalgamation or reorganization of the company is exempt from tax, where there is continuity of at least 50% of the underlying ownership in the asset. That is what it says.
Go to the next one.
What is it? Transfer by way of security, finance lease or installment still. Where a person grants a legal or applicable mortgage or a similar form of security over an asset to secure a debt owed by that person to another person. A the mortgage shall not be treated as realizing the asset or any part of the fact are still owning the asset and are having incurred a liability a secure debt. And
let's focus on amalgamation. Section 47.
realization of asset by way of amalgamation or reorganization. The gains on realization of assets are accruing to or derived by a company arising out of merger, amalgamation or reorganization of the company is exempt from tax where there is continuity of that of at least 50% of the underlying ownership in the asset.
Okay. So what it means is that if you are going through a restructuring process, then if there is continuity, if you restructure and the old interest, you don't change by more than 50%, then what it means is that you say it is going to be what? Exempt. But if you change more than 50%, we don't see you as the old company, and therefore you will be taxed on the gains. So remember two things. You will have exempt gains, and then taxable gains. But if there is continuity of more than 50%, then the gains there are what? Exempt. If there is continuity of less than 50%, then the gains are what? Taxable. Underlying ownership here means the interest. The interest. So how much interest do you owe? Let's say I am A, I am B. Here I owe 100% interest. Here I owe 60% interest in B. Then if we decide to merge, I want to reduce my A interest to maybe 48%. It means I'm continuing with 48. I have changed. The change is it 52? So the change is more than what? 50. I'm continuing with less than 50. If I continue with less than 50, I have taxable gains. What is it? What you say a question in our own below. Or better, then the same you will see. So get the principles right. Underlining ownership before the restructure, what was it? After the restructure, what is it? The movement, the change, that is called the change. So change in underlining ownership. So the change, is it more than 50% or less than 50%? So if it is more than 50%, it means that I'm continuing with less than what? 50. And if the change is less than 50%, it means I'm going to continue with more than 50%. And that will result in what is called exempt gains and intangible gains. If I continue with more than 50%, then my gains will be what? Exempt. If I continue with less than 50%, then the gains will be what? Taxable. Okay. So let's look at the taxing implications. I'm actually trying for you. Change in ownership. When ownership changes by more than 50% within 3 consecutive years, within 3 consecutive years, then the assets and liabilities of the entity shall be deemed realized. What are we saying? we say that if your underlying ownership changes by 50% within 3 years, so there is a time factor. So maybe some people will go through piecemeal form of acquisition. So year 1, year 2, year 3, no company A, and then B. Year 1, I acquired 10%. Year 2, I come to acquire 30%. Year 3, I acquire 5%. The change, how much has been acquired in terms of percent? 50, 45%. It means that within 3 consecutive years, the ownership, the interest has not changed more than 50%. It means there is continuity of 55%. So we will not say that the assets and liabilities of A have been what realized within 3 consecutive years. Even though there has been a change, there is no what realization. If, let's say B, I started with acquisition, I acquired 30% year 1. Then year 2, I acquired 20%. I have changed 50%. It's no more than what? 50. Then I come to year 3, 5%. Within 3 consecutive years, it has changed 55%. So what it means is that there is continuity of 45. The gains here in A will not be taxed, but the gains in B will be taxed. Are we okay? Within 3 consecutive years, it changes, then the gains, the assets will begin to be realized. This results in capital gains tax. The market value of the net assets at realization shall be deemed as the realized sum. So what it means is that if we say within 3 consecutive years, then the 3rd year we will measure the market values of those assets and compare it to the book values, and the difference will give us the gains or loss on realization, and that we are going to tax it at 25%. If it is going to constitute a taxable gain, if there is a gain and it doesn't constitute taxable gain, then it becomes exempt, so you will not tax the 25. Are we okay? So we are another example. B, the following shall not be available the following shall not be available to the group if ownership changes by more than 50% within the 3 years. What are some of the things? If your underlying ownership changes more than 50%, what are the things that you cannot claim?
You are not allowed to carry forward.
So one, unrelieved or carryover losses. So you can't claim them if you change by more than 50% within the 3 consecutive years. Two, financial cost. Financial cost. When we look at financial cost limit. Okay, that one is not amended. Financial cost limit. The same principle. Three, bad debts. Bad debts. C. The period before the change. The period before the change and after the change. During the year of assessment shall be treated as separate basis period. So what we are again saying is that we are doing year of assessment 2023. Then an entity changed when there was a change. So separate the basis period when the change happened, so from 1st January to 31st May, will be seen as separate from maybe 1st June to 31st December. So you have to separate them into different basis periods so that you know that at this period, what was the unrelieved loss. If it changed by more than 50%, then it cannot carry the losses to this period. So the basis period will be put into prior to the change and then post change. So after the change and then before the change. Put them into separate basis period because you are going to tax them separately. Any question? I want us to understand, get the concepts. When we finish, I'll put 2-3 questions we solve and then we go to the way. Okay, financing options for mergers and acquisitions.
So different
Subheadings. Financing options. Financing options. So how can we pay for the shares that we have acquired? How can entities pay for the shares they have acquired? And it comes with a tax implication. It comes with a tax implication. So that is why I'm looking at financing mergers and acquisitions. We can pay cash. We can also pay through share exchange. And they all come with tax implication. We can also do that through debt settlement. So in all this, know how to go about it, the tax implication. If you pay cash, let's say A is to be, the assets in A are to be acquired by B. When they have realized their assets, the assets in A are realized at their market value. And the consideration that B is to pay was made in cash. Is there tax implication? If the consideration was made through share exchange, is there tax implication? If consideration was settled through B paying some debt in the terms of loan to A, is there tax implication? What can you say about the three? So if you release cash quickly and pay, then you must pay right away tax. You pay tax because remember the acquisition was done in cash. So if you pay cash immediately, then immediately your gains, you must suffer what? Tax on the gains. But if you go through share exchange, remember that it's not going to be immediate. The returns will come when we have declared what? Dividend. And when you declare dividend, you know the tax principles. That when dividends are declared, you will pay tax at 8%.
So this taxing system under the financing is on the part of the one receiving the cash or the one paying.
You have investment. We are looking at not the, you see that both are groups. It's a group, when they merge, they become one group. So when A suffers, it will affect what? The group. When B suffers, it affects the group. So if you make outright cash payment, it means that that very moment we are to pay what? Our capital gains. We will suffer tax immediately. And therefore, if you pay that 25% tax as a company, it is going to reduce your what? Cash that is available to you immediately. But if the issue says the one which did the acquisition, the acquirer, is going to gain what is called dividend, and it is within that what group. So when dividends are declared, that is when we are going to withhold what? 8%. Are you getting it? Then if they make share exchange as the group itself, share exchange, the dividend paid are not allowable deductions. So it will affect what? The company. Are you getting it? But when I come here, debt settlement. If they gave me debt, what it means is that I am going to pay interest as the group. So if the interest paid from the group, the law is that it is deductible expenditure. So I can pay the interest and still deduct it from my chargeable and accessible income before I will pay what? Tax. Are you getting the principles? But when it is shares, I cannot deduct the dividend. So it will affect what? The entity. Because each year I will pay dividend, but I cannot reduce my tax liability. Are you getting the principle? So always, the methods of financing, look at it well. The examiner will ask you which of the methods is will help the entity maximize their tax liability. If you want to reduce your tax liability, it's better you go through what? Debt. Because interest on the debt is allowable for tax. Then the one who will receive the interest, if that entity, you forget about the one who is receiving it. If it is an individual, then that interest, if it's from investment, then it will be taxed at 1%. Individual, 1%. If it is a company, other than the 1%, if it's a financial institution, interest on savings, that one is exempt from tax in the hands of individual. But if it's from investment that you make and they are paying you interest as an individual, you suffer tax at 1%. Then as an entity, that entity will suffer tax at 8% withholding. So debt here, the entity can have the opportunity to deduct the interest, and that will reduce their tax obligation or tax liability. But for the other entity, that entity will suffer tax, withholding tax at 8%. So get this principle, because always they ask, if you want to reduce your tax burden, then it's better you go to debt finance, because you are likely to deduct interest paid on the debt arrangement. That is the principle. But you take note of 10 capitalization, where the debt is from controlled person. So if it's from a controlled person, then it should not exceed what? 3:1 ratio. So that you can deduct all what? The interest. Otherwise, if it exceeds 3:1, then you cannot deduct all the interest.
So the reason for the share exchange is that and then you have to pay dividend, and the dividend is taxable.
Yes.
But what about the cash?
Dividend is non-allowable expense. So to the group, they cannot deduct the dividend as an expenditure.
But what about the cash?
If you make cash payments, then it is going to reduce your capital that you have. So you will not have access to funds as a group. Oh, I don't think most of it they will look at it from here in terms of the entity. So is it okay on debt settlement and share exchange and cash offer, the tax implication?
Essentially, with the share exchange, if it's with the acquirer, you know that it's taxable at
8%. Your obligation as the entity, the acquirer, is to withhold 8% when you are making dividend payments.
And then the acquiree also knows that at the end of the year, when dividend is paid, he's also going to pay 8% of.
That one is what was withheld.
Yes. Okay, we'll see that.
Okay. So, cash offer. When acquisition is immediately settled by cash, capital gain is realized on the assets acquired. This gain is subject to tax if the change in ownership is when we reach out. If the change in ownership is more than 50%. Share exchange. Acquisition settled by share exchange results in deferred capital gains tax. Why are we saying it will result in deferred capital gains? Dividend are paid, no. If we say deferred capital gains, it will not be on dividend. Deferred capital gains, it means that if the person exchanges shares for the shares in that entity, we are not going to declare the gains immediately until in future when the shares are sold. But each year, the person will be paying what? Dividend to the acquirer. And when dividends are paid, that was where I was saying that it will not be allowed as what? A deduction. Results in deferred capital gains until when the shares are disposed in the future.
So, what if the shares are disposed and there is a loss of the disposal
The shares
in future?
in future. Now, overturn or shares I'm making loss. Then the entity, and they're vibrant. If there is a loss on disposal, then no capital gains will be paid. You only charge it as part of your income to reduce your liability. So you write it off that loss through your income. But when you are making losses, if you sell your shares, you are making loss. What it means is that at the time of purchase, you purchase it for maybe 5 shillings. Now the company is not doing well, and this value has come to 2 shillings. So under that situation, you are making a loss of 3 shillings. So what will happen is that if you are a shareholder, because you have made a loss, we cannot tax you on a loss. So what you do is that go and use your this loss to set off your profit that you gain. If you are an entity, if you are an individual, then your other income, you have to use this to reduce your liability. Dividend income on shares. Dividend income on shares purchased. Dividend income on shares purchased by the acquirer. By the acquirer. may be subject to 8% final withholding tax. By the acquired company. Somebody is asking that what if I owe 25%? If you owe 25%, we stated last time that it is what? Element. Meaning I pass it to a meaning I will say, woman, about what you and then I'm then dividend paid is not allowable deduction. Dividend paid is not allowable deduction by the acquired company. Then the debt settlement. Debt settlement results in increased liabilities. Results in increased liabilities. Of the new company. Debt holders are entitled to receive interest income. Are entitled to receive interest income. Stop. The interest shall be treated as a deductible expense by the acquired. by the Accra. A withholding tax shall be made at the applicable rate. So I'm not mentioning it because if it's an individual, then they will be paying maybe 1%. If it is an entity, they will pay 8%. So know when to use them. The withholding tax. What did I say? At the applicable rate. On the interest paid as income to the acquirer. Note. Where the debt is acquired by a non-resident person as well as controlled persons. Care should be taken of tin capitalization ratio of tin capitalization.
Is when the debt is acquired by non-resident person as well as
A controlled person. Care should be taken of tin capitalization. Okay, so that is that one. Okay, let's take one question. When we finish, we take another from the past question. You may write the platform so now again or recording the line. Okay. What if you also from Okay, I've posted the question. Review question 1. Let's look at that question and the tax implication.
Show the capital structure of Aboki and its related parties for the years 2018-2020 and comment.
Questions.
1.
Review question 1.
B. The data below which relate to the end of year 2020.
So I think the A portion is questioning you on the question 1. Then B is a separate question to all.
So, Aboki Limited is a wholly owned private company and prepares accounts and
No, the micro measure.
prepares accounts and prepares.
Now begin reading.
Aboki Limited is a wholly owned Ghanaian company and prepares accounts to the 31st December each year.
In
2018, Visa Limited acquired 20% shares in Aboki Limited. In 2019, Visa Limited further acquired additional 10% shares in Aboki Limited. While Liberty Limited also acquired 10% shares in Aboki Limited. In 2018, Visa Limited further acquired additional 5% in Aboki Limited. While Liberty Limited also acquired additional 50% shares in Aboki Limited. Show the capital structure of Aboki Limited and its related parties for the years 2018 to 2020.
and comment on it. The message So Aboki Limited is a wholly owned Ghanaian company preparing accounts to 31st December each year. In 2018, Visa Limited acquired 20%. So Aboki and then Visa. This is the capital structure. So capital structure of Aboki and its related parties. So Aboki, let's say 2017, Aboki had 100%. Then in 2018, this Visa acquired 20%. So Aboki will have what percent? 8. Continue.
In 2019, Visa Limited further acquired
Further, so he increased from 20 and acquired 10. So now Bisa has 30%. Then this one will have so they must dy
and no, it should have been
Nast. Nast.
yes
dy.
acquired 10%. So it means this one will reduce. To 60. So now this one will have what percentage? In 2016, Visa will have what?
30.
Are you getting that? This will be 10. So in total, here was 100. Still 100. Then still 100. Visa additional 5%, so plus 5, 35. So 15 plus 10 will be 25. So this one will now have another 14. Yes.
Yes.
Percent. Now what happened?
Show the cash structure of booking and then related parties for the years 2018 to 2020 and the comment.
So this is A. That is the capital structure. So what can you say? What will be your comment? What will be your comment? The change in where? Aboki. So you talk about Aboki. That within 3 consecutive years, Aboki Limited underlying ownership has changed more than 50%. And so any gains on realization is very important. Any gains on realization is taxed up. Not again. No, that's sample. So all the assets and liabilities of Aboki are deemed to be realized at their market values. Then we come and talk about the gains. Taxable. But again, if your gains are taxable,
You are not allowed to carry over.
you can't claim the group cannot benefit from. Now what you're tracking? And control about who first we now sorry go. I think be a fan yeah, when you 8 years or so. It's me the basic will be a fan be a natural. Make us a way yeah. The
That's no particular order.
I will try more than this one answer.
This person of God is this with the analogy.
This is too
Say,
much.
the analogy can kind of number first.
And the answer a cat 18. What again? So this is the capital structure. This is the capital structure of Aboki and her related parties. So Aboki Limited will have this. Visa Limited will have 35. And then Dynasty will have 25. Then your comment will be that within 3 consecutive years, Aboki Limited, Aboki underlying interest in Aboki Limited has changed more than 50%. If it has changed more than 50% and so, it means that the assets and liabilities of Aboki Limited are deemed to be relevant. The gains on realization are taxable. Then the period before the realization and after the realization are separate basis period.
So your question is that the final change in the ownership of Aboki Limited took place on the 31st July 2020.
So from 1st September and August to 31st December, it will be separate basis period. From 1st January to 31st July will also be separate basis period. And therefore, the losses, the B part mentioned some items there. Those things, you have to look at them and say that those, because it has realized more than that, it cannot carry them from is it 1st August.
When would they in 2020, that's what they will be separate base period.
Yes, 2020. 2020.
So in the case where
So here in 2018, Aboki, the net assets are not deemed to be what realized.
they continue,
Within 3 years, that was when he was realized. So here there was continuity of more than 50. Continuity of more than 50. So at this period, if Aboki had any loss, financial cost to be carried, it will be allowed to carry them. But when he comes here, the losses that were made after or before 31st July cannot be carried forward to 1st August onwards. Are you getting the principle? I have a B. The B said what? Or there was no B.
data below
Okay.
which relates to the end of 2020 year of assessment is relevant. The net cost of the assets of Aboki Limited immediately before the realization is 1.6 million. Aboki Limited had an unrelieved financial cost of 12,000. Aboki Limited had an unrelieved loss of 23,000. Aboki Limited refunded an amount of 1.2 to Mr. Seymour in January 2024. A stock he bought from Aboki Limited in February 2019, which became effective before the expiration of the contract period. One of the debtors of Aboki Limited who owed 34,000 became bankrupt in February 2020. The final change in the ownership of Aboki Limited took place on the 1st July 2020. Determine the tax treatment of the transactions of Aboki Limited and the basis period.
So let's look at that one and how you have treated them. Can we run this one? the BPAT is looking at the taxing implication. So what you do is that put the basis period. And in 2023, it would have been from 1st 2020 to 31st December 2020. But because of the acquisitions, the acquisition was done in 2020 on 31st July 2020. So separate this from after the acquisition, 1st August 2022, 31st December 2020. So this is 1st 2020. So this becomes pre-acquisition change, then post-acquisition. So here, if the entity had any condition here before this date, then that condition should be written off here. So I had bad debt, I had foreign exchange loss, I had finance cost. Those things can be deducted here, but they cannot come here. So if you don't take care and then each period expires, it cannot be carried forward to when the change occurred. I get in the principle. Of two questions now, if you are confused. The losses, if there were losses here, and all of them can be deducted here, it's better they deduct. But when the change had occurred, after the change, you cannot what? Carry. Because it changed more than what? 50%. So let's look at those conditions. It says one. A.
The net cost of the asset of Kabuki Limited
Immediately before the realization is
1.6
million. So net assets before realization. So at this point, the net assets were 1.6 million. So when they come here, then it means that those net assets will be realized at their market values. And they will qualify for what? Capital gains tax. So you will charge capital gains tax. You compare if this will be at their book values. So you look at 1.6, if there is market value of let's say 2 million, then you deduct 2 million from the 1.6 from the 2 million, and you get the gains. And tax what? That gains, because it has changed more than what? 50%. Are you okay? The next one.
Kabuki Limited had an unrelieved financial cost of 12,000.
So unrelieved financial cost of 12,000, and that, if it is this period, he can deduct it. But if he waits for that 12,000 not to be deducted, it cannot come here and deduct. Do you get the principle? At this point, that 12 million financial cost, because at this point the change had not what occurred. So at that point, he is allowed to deduct. If he doesn't deduct it and it comes here, he has realized and those conditions cannot be benefited from. Are you okay? The person had a financial cost before the realization or before the change. If it's before the change, then he has the right to do that.
Do you not pay a certain amount, but that one doesn't have any?
It depends on the limit for financial cost. There is a limit on that. So if all the 12,000 can be deducted, fine. But if all cannot be deducted, he cannot carry any of that 12,000 to the post-acquisition period.
Bookie Limited had an unrelieved loss of 23,000. 23,000. Bookie Limited refunded an amount of 1,200 to Mr. Sigma in January 2020 for a stock.
So the third one, what can you say about it? Aboki having unrelieved loss of 23,000. What can you say?
You are allowed to write off every loss under the basis period from 1st January to 1st July. But afterwards, it is not allowed to.
So it will not be allowed as a deduction after the realization because it has realized more than 50%.
But since they didn't mention the period, it just, or is it, they didn't say
It says that the final change in the ownership of Aboki Limited took place on 31st July. The final change took place in 31st July. So if you had any condition before 31st July, you can deduct them. After 31st July, which is 1st August, you cannot. Because you have changed more than 50% of your underlying ownership within 3 consecutive years. That is according to section 62. Change in underlying ownership. But when you come to section 47, that is where you look at exempt gains and then taxable gains. The next one.
The fourth one is bad debt of 1,200.
Bad debt of the fourth one.
Yeah.
Refunded an amount of 1,200 to Mr. Sigma in January for a stock he bought from Aboki Limited in February 2019, which became effective before the expiration of the guarantee period.
Okay. So you see that it was a condition before 1st August. So he has the right to deduct that 1,200 within the first basis period. Or will lose that right when it gets to 1st August. Then the last one.
One of the debtors of Aboki Limited who owed 34,000 came back in February 2020.
The one of the debtors owing 34,000 became bankrupt. So that is a specific bad debt. And once the commissioner accepted that, the condition was in 2020 February. So before the change, he has the right to deduct it, but cannot claim it after 31st August. So that is an interesting question to help us revisit all the discussions.
Supposing that the last.
So with the required, determine the tax treatment, is it calculation? Or
No. You
it's
state what
rate-
you were saying. What you were saying for each one. That you can deduct it here, cannot do it here.
So supposing that, Mr.
Aboki Limited, it's not being Mr. This one is Aboki Limited.
One of the debtors went from Bangkok in early September.
February.
No, I am just assuming that if the person had gone on, the debt has
In
gone.
September.
It will-
Then the condition was in September. It happened after
Afterwards.
the realization. So you cannot claim it here. You can't claim it here. It's after the acquisition. So that one it will happen here that you have a bad debt of 23,000 here. It will be seen that the new company has a bad debt, not the old company. Okay. Let's see in the past question. So give me question back.
Fair question.
Mergers and acquisition. Okay, let's take the past question. Think 20. Twenty 20.
Give me.
Yeah. Is it question one?
So, when we are done You can check 37, I don't know whether it's a measure question.
37. Discuss the deductibility of business loss, foreign exchange losses. That is from business expenditure, deductible expenditure. 2020 May. Okay, that one was on. It says what constitutes Ghanaian permanent establishment. Explain the taxing rules on Ghanaian permanent establishment. Then explain two concepts of double taxation. That is juridical and then economic. Then transfer pricing. Then trading in Ghana, trading with Ghana. That was something related to mergers and acquisitions. Then Columbia University has written to, okay, for universities, what they are to do is that the only tax incentive available to a university, a private university, is that you need to plow back all your profit made in order to be exempt from tax. So if you plow back all the profit, 100% of the profit made during the year of assessment back into the university, then you will not pay any tax. Otherwise, you have to pay tax. That is the principle. Question 16. Okay. Question 16.
What is the tax implication of a merger?
16 of question bank. Tax implication of a merger. Read it.
What is the tax implication of a merger between two companies where each entity has 50% in the post-merger arrangement?
So, after the merger, this one is continuing with 50%, another is also continuing with 50%. What will be the implication? It has not exceeded 50. And so what is the implication?
Which means that the net asset hasn't been realized.
Okay.
So
No. Even they could be realized, but the gains from
it's not
is exempt. It's exempt. They also already can. The gains will be exempt because each one is continuing with 50%. So they will have exempt gains. It will not be taxed. If they have exempt gains, then bad debt, unrelieved losses, foreign financial costs.
So at what point can we cite unrealized net assets having been realized?
Not that your net assets have not been realized. Whenever there is a change, we have to measure the gains. And when we are measuring, we will look at you making a gain, but has your underlying ownership changed more or less? If it has changed more than 50, then we will tax the gains. If it changes less than 50, we will not tax the gains, we will exempt it. mean, purpose. Past person. We always look at it from that way. I check my notes. I have some years and the ambitions over there. Yes. No, not the one I posted. Oh, yes, the one I posted today. There are some persons in it. Direct one and two. Mm-hmm. 2021 May. Question 2. Twenty 2021 May. Question 2. Can I read it?
Question
2. A.
reply as instead of item, exactly. It's available to your partner on your company's tax exposure after the merger. There has been a measure about the amount of great companies, unlimited, bar limited, and C limited. The measure was geared towards creating a monopoly in the market. After careful evaluation of the assets and liabilities of the companies, the following is the outcome. Based on evaluation. The following is the outcome of the new company after the year. 4, 5, 5 after instead of item and associate to your partner on the company's tax exposure after the year.
Read it well and gain the understanding first before we tackle. It says write what? A memo. So you need to know the format of a memo. And what went on, there has been a measure. So quickly, your thought should come to section 62 and then 47 of the Income Tax Act. That has there been a change in the underlying ownership? Yes. How much is the change? 50% or less? 50%, yes. Then there is continuity of less than 50. Hence, the gains will be taxable. If less than 50, then the gains are exempt. If the gains are exempt, what happens? Are exempt.
All losses are allowed to be carried.
Thank you. The gains were exempt. It means that there is continuity of more than 50. Until loss, bad debts, unrelieved loss, and financial costs are allowed to be carried forward. Okay.
And I know you only assume for the thing.
Me, I'm not assuming. I have not read the question.
Because here they don't say what it used to be and what it has become.
Read the question.
Then I had been a measure amount where happening. And the family the measure was jailed or was created, and we will put it in the market. After careful evaluation of the assets and liabilities of the company, the following is the outlook. Gain from revaluation. R limited 4.2, BAC limited 5 million, C limited 5.2 million. The following is the output of the new company after the million. Profit 5 million. As an intern of ICANN and associates, write the memo to your partner on the company's tax exposure after the year.
Okay, so you see that this one, they did not mention how much each one has changed.
Yes.
C and others. So what you should think of is that you write on 2 that if they have changed more than 50%, then they will be taxed. If they have not changed more than 50%, then they are exempt. Do you get what I'm saying? Because it did not limit you. So you have to write on both sides. Are you okay? So let's take it. You put your memo down and let me see. Memo. It says write a memo
To your partner.
to your partner. So to partner from no from because you are told you are intern as a tax intern. So from tax intern, then you give date and then the subject. It says you should do what?
Write to your partner on the company's tax exposure.
So tax exposure. So is the company exposed to any tax? So what are the issues? So you have to identify the issues. Then when you are finished identifying the issues, you come and look at the tax implication. That is called the tax exposure.
Yeah.
And what are you waiting? Actually, we are now they are showing so you see. And the old trial in the aircraft. And your program, I say, and your program. I was yes. Yes.
With this question, so we know the concept of measure before and after a measure. But with this question, how do you pick your answers? Because as a guy,
So the entity has gone to measure. That is the whole question. That the entity went to measure and now they did revaluation.
and we have all
No. That was profit after the measure. Profit after the measure. But you are to write on the measure. So what it means is that once you have gone through merger, your assets and liabilities are deemed to be realized. And when your assets and liabilities are deemed to be realized, if there is continuity of at least 50%, then you have present gains. So you are to write on both situations, everything about merger. Because you were not told whether there was continuity, whether it was more than 50 or less than 50. So your report should be on everything. That if there is continuity for more than 50% or more, then you have exempt gains. Less than 50, you have taxable gains. Then after the change, you cannot carry forward those things. You list them. Because the person did not limit you, they want you to write, test you about your understanding of measure.
so you can still be in a bullet.
This one, I mentioned, you have to, it says a memo, so you don't need to bullet. Because you only have to get the format. Or two. Then from, then date, then the subject. Then maybe if you begin your body or with a quick introduction, then you identify the key issue. Then you want to look at the tax implication. Then when you are finished, you sign. And then write your name.
So in writing the key issues and implications.
So the key issue here is that there has been a merger. So when there is a merger, what happens? Assets and liabilities are deemed to be realized. When the assets and liabilities are deemed to be realized, was there a change? So a change in ownership of more than 50% results in taxable gain. So if a person wrote here less than 50%, then that person is here excess. Depends on what you are saying.
Somebody can write books. Since you are talking about them.
You, then I come to tax implication that after the evaluation, those entities, depending on their change, they will be taxed or not. Then we come finally that if post acquisition period, they cannot carry on with these things. That is how we go by it.
So in both you cite the two scenarios.
Yes, when I come here, if I raise this one here, when I come here, the tax implication of what I have written here is stated under the tax implication. And when I finish, you come. This is not a report. I can have a slide conclusion to summarize what you wanted to do. 3 pages on this question. It's just a word. And truly, I don't know how can crave in our past 50. 50.
Same public.
I wasn't.
One,
Okay. Come back at 2.
With the point, you talk about the asset being realized. Then the basis period, which should be separated, is also a point, or it's not a point under then the unrelieved losses, which could be carried over or not.
So we've not talked about the change.
Okay. I thought that I
Change.
if they change, well, I think with the change, if the change is more than 50, I was mentioning a point. That point is already there, like, and the underlying interest, the change, whether it's more than or. Then I want to know the point. if what I have here is right, we mentioned the unreleased losses, the assets, which will suffer after years or depending on the change. Then the separate basic period, whether it will the unreleased losses, you talk about that, I talk about bad debt as well.
All will come when there is, depending on the changes. So if the change is less than 50, then it means you can carry forward all those conditions. But if the change is more than 50, you cannot carry them.
So unreleased losses, bad debt,
Financial cost. I resume from the page. You look at this one. Because for merger and decision, when it comes, we need to score. If we don't score, then it means we don't want to pass. Because the understanding is very simple. I'm on break. It's not go to